Welcome back to another episode of the Morales Group Show. Today we have a very special guest. His name is Edwin Kelly. He's with Specialized Trust Company. And today we are going to be talking about how to do a real estate loan through your self-directed IRA. We're going to talk about, first of all, what is a self-directed IRA, very briefly. And then if you have a self-directed IRA, we're going to talk about how to make real estate loans on that. Who can you lend money to? What is the process to lend the money? How do you figure out what rate to charge? How do you figure out if you charge points? How long of a term, interest only, non-interest only, secured versus unsecured? It's going to be an all-inclusive video. You do not want to miss it. Welcome to the show, Edwin. How are you?
Jose, man, it's great to be here. I'm glad we were finally able to. We've been talking about this for so long, and so I'm super excited that we finally were able to get it on the calendar.
Yeah, same here. And I think the reason I'm so excited is I think there's this whole other world that people don't know about. And I think if we can help educate people on how you can take more control of your 401k and basically not have it be subject to so many market changes, I think it helps people. So let's start off here. For our viewers that don't know, what is a self-directed IRA? And then how can somebody get a self-directed IRA? Meaning, like, if I have a 401k at my company or a previous employer, how does that process work?
Yeah, so that's a great question to begin with, because there's a lot of misunderstanding of what a self-directed IRA is. If you were to open up, and I'll use this company specifically as an example, if you were to open up an IRA at Scottrade, the Wall Street firms have kind of caught on to this, and that there's more and more money being moved into self-directed IRAs. So when we get statements, when clients are transferring money over to us, Scottrade statement, it says at the top, self-directed IRA statement. So people use the term, but it means different things to different people. So I'm going to make this easy, because I like making things simple and easy, because when it's simple and easy, then we can go do something with it. So I group IRAs, in fact, I'll just say all retirement accounts into two categories. Okay, there's what I call plain vanilla, and there's what I call truly self-directed. So what's the difference? A plain vanilla account is one that you would get at a bank or a brokerage firm, right? And so what a plain vanilla retirement account does, it allows you to invest in basically what we call marketable securities. So it's stocks, bonds, mutual funds, and CDs. That's pretty annuities, right? There's variations of these instruments, but that's the group it falls into, right? By contrast, a truly self-directed IRA removes those handcuffs, removes those restrictions, and allows you as the IRA or the retirement account owner to invest in anything allowed by the government, which is virtually everything. So things like cryptocurrency, notes, mortgages, deeds of trust, real estate syndications. I mean, physical precious metals, right? I mean, virtually anything you can imagine, you can invest in. So then the question is, well, how do you know if you have a truly self-directed IRA or not? When the government wrote the rule book on retirement accounts, they said, hey, these are the rules, right? We can't go outside the rules. That's called breaking the law. Or in our world, we call them prohibited transactions. So we can't go beyond what the rules say. But what they also said was, a for-profit financial institution offering retirement account services does not have to allow everything that the government allows. They're allowed to restrict investments. So what that means to you and I is that it is the firm, right, the licensed financial institution that holds the retirement account that gets to determine what they will hold in your retirement account. So in other words, to have a truly self-directed IRA, you need a self-directed IRA custodian. And that's the role that Specialized Trust Company plays. So we are a self-directed IRA custodian. Every client who has an account with us is able to invest in anything and everything allowed by the government. That's what removes those restrictions and gives you complete control over your money in your account.
Well, and it's funny because now I can relate to this, because I used to have my 401k with ADP, and with ADP, I had like 5 or 6 different options of what I could invest into. There was like a growth fund, retirement fund, just different funds. But what I noticed is that because they were mutual funds, the fees were really high on the back end, and the return was not really predictable, meaning it was volatile. Like one year it'd be up, the next year it'd be down. So if you actually averaged it out and subtracted the fees that are associated with that, I wasn't noticing my 401k increasing. So then I thought to myself, I'm like, hey, I'm a real estate guy. I like real estate. I understand real estate very well. I read this book called The Banker's Code, and it talks about how to become the bank and how banks actually have a lot less risk than the investor. And that book started changing the way that I thought about like real estate loans. And now I obviously have a self-directed IRA. So let's say that somebody already has a self-directed IRA and they're like, look, I'm considering lending money on real estate or real estate projects. Can I lend to myself? Can I lend to my parents? Could I lend to my brothers? Could I lend to my friends? Who can I lend to and who can I not lend to? And then once we determine who we can lend to, what is the difference between a secured loan and an unsecured loan as well too?
Yeah, so two great questions. So the first question really goes to an aspect of the rules and regulations, right? So the government basically said so, and again, I'll tell you, I'm a big fan of note investing from a rule standpoint, and when I kind of and I'll share some information with you here, and then it'll make sense why, right? So when I hear about uh, so I'll say some of the objections or questions that people have if they're new to self-directing and they're saying, "Hey, I'm thinking about doing this. I've heard about it recently, but I've also been told there's lots of rules and things that you have to go by, and you don't want to make any mistakes." Okay, so first of all, that's true. There are rules we have to go by. It doesn't have to be overly complicated, and it really depends on what kind of investments you're doing. Four basic prohibited transactions that we all need to be aware of. The prohibited transactions is government speak for these are the things you're not allowed to do with your retirement account, right? So the first one is you're not allowed to buy life insurance. Now, I say life insurance is good to have. You should have it. I have it. We just don't buy it in our IRA, right? Second thing that we're not allowed to do is extend credit to our retirement account or personally guarantee a loan for our retirement account. Now, we probably don't have time to get into that today, but that's really important rule, and here's why. What that tells us is that it's not prohibited to borrow in our retirement account. We just can't personally guarantee a loan for our retirement account. Third thing we can't do is we cannot buy beer or wine in our retirement account. Now, you're laughing, but that's actually, believe it or not, they put that in the rules. They put in there a section called no alcoholic beverages, which falls under a bigger heading called collectibles, right? So artwork, gems, stamps, rugs, right? Things like that. So no collectibles. Okay, so those are three of the four right there, right? And that's not overly complex. The fourth one is the one that you're asking about, and that is the government says we're not allowed to do any self-dealing transaction with our retirement account. Now, there's a few different aspects to self-dealing, but your specific question goes to what is referred to in the code as disqualified individuals. So, in other words, the government, in their infinite wisdom, said when they wrote the rule book, they said, look, there's certain relationships that you and I have that if you were to enter into certain types of investments or transactions with somebody that you have this type of relationship with, there's too much room for funny business. Now, funny business is my term, and that's the term I use to say the government doesn't want you defrauding them out of any tax revenue that they might be entitled to in their mind. So created this list of disqualified individuals and just said you can't do certain things with these people on this list. So who's on that list? Easiest way to remember that is that it's up and down your family tree. So it's your grandparents, your parents, yourself, your spouse, your children, your grandchildren. So what does that mean? And we'll talk about it from a note standpoint because that's what we're focused on here today. So if I want to invest some of my money in my retirement account in a note, right? So let's say I'm going to lend it to you. If you're on that list, I can't lend it to you. If you're not on that up and down list, I can lend it to you. And the same would be true, right? Vice versa, right? A dad couldn't lend me his retirement account. Now, To clarify that though, because again, people come at this from different angles, you are an active real estate investor. And so if your father came to you and said, Jose, hey, I'm interested in investing in notes like you do. You're the expert in it. Can you help me out? Well, the answer is sure, Dad, right? Because he doesn't have to lend it to you. If you are sourcing note deals, he can enter into a note between his IRA and someone that's not you. So could you help him find the opportunity? Could you help him structure the investment, do all that? Sure, you could, right? Because you can provide him guidance. He just can't invest directly with you in that capacity. And so here's the other thing I'll mention about that, because that's something that comes up because people say, well, I understand I can't really invest with my parents or my kids or whatever. And the answer is that's true, right? You want to keep very clear lines here. But the reality is that I don't know anybody who's gotten wealthy off of investing with their family.
And then just so that people understand how great this is, like let's say you have a friend, he wants to buy a rental property for whatever reason. He's going to go to the bank, and the bank is going to basically underwrite him and then make him a loan. If you wanted to, you could actually make the loan for him. Let's say that you buy a property, he buys a property for $100,000. You lend him $65,000 to buy that property. He puts $35,000 down. Then at that point, you're the bank, which means he makes monthly payments to your self-directed IRA account, which means, and this is what I like about it because it's so easy to understand, my 401k was averaging about 6%. You can lend money on real estate projects 8.5%, 9%, 10%, 11%, 12%. What does that mean? That means that I am getting 10% on my money, which means my self-directed IRA is growing at a 10% return versus a 6.5% return, as long as it's secured by the property. The other thing that it means is that now, instead of going up and down, my self-directed or IRA is growing by the same amount every single month, basically. So it's like extremely predictable as long as you do the real estate lending in a way where it reduces your risk. Obviously, no type of investment is ever risk-free, but there's ways to protect yourself with that. So what is the difference? Like, let's say that, or what should I look for? Like, let's say that I'm making a real estate loan to somebody and they're buying a property. What is the difference between a secured real estate loan versus unsecured?
Yeah, so great question. And from a custodian standpoint, right, when we're holding an asset or we're holding an investment, this is how we kind of segregate it, right? We separate out secured notes from unsecured notes. You can do either type of an investment with your self-directed retirement account. Having said that, neither one is prohibited, so you can do either, right? And we have clients who do both kinds. What I always suggest to people is, first of all, make sure you know what you're doing, right? That's paramount. And my preference is secured notes because we've had situations, I've had situations personally, right, where I've lent on deals and the market can change. When my money is secured, I can actually take back the property. So I have an asset. Sometimes, right, an investor market might change, something comes up, they need a little bit more time to make good on that note, to exit the property or whatever the strategy is. And when you have it secured by the property, they don't want to lose the property, right? Because they've got profit built into that deal. And so they'll work with you oftentimes, right, to get that note into a performing status and to make good on that note. That's only true. I shouldn't say that's only true, but that's for sure true when you have a secured note because, right, you have leverage because you have the asset behind it. That's one of the things that I love about note investing. A couple of reasons. One is that you can secure your money. So unlike like what you're bringing up with the mutual funds, right? If the market goes up this year, your funds will go up, but because of the fees and commissions, it won't go up as much as the market typically. When the market goes down, it can go down more because of the fees, commissions, and you're getting the full down side of the market, right? Your account is capturing that. Whereas on something like a secured note, you have an asset-backed investment at the end of the day. There's some intrinsic value in that asset, whatever it is, right? Values may fluctuate, but there's real value there. And so when you secure your money with a real asset, that gives you a lot of leverage. It gives you a lot of security, right? There's a lot of advantages to secured notes. Now, by contrast, right, an unsecured note is just what it sounds like. It's unsecured, so it's based by the full faith and credit of the borrower. And so again, we have clients who do both, but I always just say, make sure you know what you're doing and the agreement that you're entering into so you can make the best decisions for yourself.
So basically, like if I have secured, that means I have a loan recorded on your property, meaning that like you can't do anything, you can't sell, you can't refinance without paying me off or talking to me beforehand. If it's unsecured, you're basically, it's almost like a handshake deal because it's not secured by anything basically at the end of the day.
Yes, and that's exactly right. So think about it from the bank's perspective, right? Like you brought up the bank earlier. If you own a property, like who gets their money first? You or the bank when you go to sell it. The bank always gets your money first. That's a good position to be in.
Yeah, and it's funny because whenever you're making real estate loans, that's the way to think about it. The way to think about it is you're basically the bank on that real estate deal. So if you look at your documents, whenever the bank makes a loan to you, they will have a note and they will have a deed of trust oftentimes. What is the difference between the note and the deed of trust? Just so that people understand, because when I got into this, that was kind of like, oh my God, like what's the difference? Why do I need these two different items? And I didn't understand it.
Yeah, so the deed of trust is a document that shows, right, that you have a claim or a lien against the property. The note just simply usually shows, and again, it depends how these things are drawn up, but the note generally will show, hey, that you lent this amount of money and these are the terms. And that's one of the things that people get confused sometimes, because I will say you always want to make sure when you're lending money, if you're doing a secured note, make sure your interest is being recorded, right? That is absolute paramount to make sure that is taking place.
Yeah, if you're doing a secured one. So basically, a note outlines all of the terms of the loan, like, okay, what interest rate? Is it principal and interest? Is it interest only? How long is this loan for? What's the amortization on the loan, basically? If you look at a note from your bank, it basically outlines all of the terms of the loan. And then if you look at the deed of trust, that basically is the recording instrument that allows you to record that against the property. And basically now, you have your interest on that property. Now, I didn't know this when I started doing notes in deed of trust. How important is for you to hold that original note till that loan is paid off?
It's a good question, and I'll tell you, there's different schools of thought on that. We, as the custodian, I will tell you, generally, we do not hold the originals. We keep copies of everything, but we will send the originals to the client. So the client actually holds the original, right? Um, my opinion is that it is valuable for you to have, right, those documents. And that's why we do it the way we do it. So we record keep everything, we keep copies of everything, but we will send those type of originals onto the client.
So this is what my title department told me, that in order that you need to keep the original to keep it, not you, me as the person making the loan. And they basically said like, hey, you probably want to keep that in a safe because basically, um, if something ever went wrong, the original note is what you would need to basically take legal action. And it's funny because I paid off a commercial building recently, and the bank sent me the original note basically with a stamp saying paid, and then it had my original initials. And when I saw that, it kind of made sense at that point. So let's talk about this. What is the process? So let's say that I go to you guys and I say, look, I found an investor. He wants me to make a real estate loan to him. I trust this investor. Obviously, I've done my due diligence already. What would that look like on your guys's end? What is required? Is it as simple as saying wire the money to this person? What type of paperwork is required? What type of information will you guys need in order to
The
facilitate?
way I frame this is that it is a 3-step process. Okay. I call it my triple D process. The first step is to decide. What do you have to decide? There's various ways of coming to this conclusion, but the conclusion is, hey, I want more control over my future. I want control over my money. I want control over my largest investable asset. For most Americans, their largest investable asset is their retirement account. Okay, that's true for a majority of Americans. Retirement accounts make up about 30%, about 35% of all American households' assets. But when you look at the things that they're allowed to consider in assets for the government's purposes, it's things like their cars, equity in their home, right? None of these things are investable, right? So the retirement account actually makes up the largest portion of a person's investable assets. That represents your future wealth, right? That represents your future security. So the moment you decide that you feel you are care more about your money than some, anonymous person on Wall Street doing things, the moment you make that decision, then you set up and establish a self-directed retirement account. We do this all online, right? It takes about 15, 20 minutes to set up an account. We have people who walk you through it step by step, right? And so now you have your account established, your self-directed account established, which completes step number one. Step number two is to deposit money into that account. There's effectively three ways of depositing money into a self-directed retirement account. The first way is a contribution. And so most people are eligible to make a contribution every year to a retirement account. If you have earned income this year, you can take some money out of your checking account or your savings account and deposit it into your self-directed account, right? So that's one way to do it. Second way to do it is a transfer. So a transfer is where you take money, either all or some, from an IRA at a bank or brokerage and transfer that into your self-directed IRA. By the way, when you do that transfer, it comes over dollar for dollar, right? No taxes, no penalties. So I always say, let your new custodian handle the transfer for you because you don't want that done incorrectly. Third way that you can deposit money into an account is through what's called a rollover. Now, rollovers mean different things to different people. The way that most people use the term, which is how I'm going to use the term today, is that they mean they're going to take money from an old 403b, 401k, TSP, and roll that into their IRA. Again, same thing is true as long as it is done correctly. And if you have your custodian do it, it'll be done correctly, right? Then it comes over dollar for dollar. So if you have $100,000 in your account, wherever it's at, 100,000 shows up in your self-directed IRA. The way you frame that question, and this is really important because this is one of the best practices and one of the biggest mistakes I see investors make. Someone will say to me, "Hey, Edwin, I want to self-direct, but I don't have an investment yet, so I'm going to wait till I find one to open the account and move the money over." You're going to lose your first deal. Guarantee it. Why is that? Because we can set up the account, like I said, same day, right? It takes you 20 minutes to do this. It doesn't take a lot of time to do that. The problem isn't with setting up the account. The problem is moving the money. And so custodians, contra custodians, as we call them, wherever your money is now, that process can take anywhere from 2 weeks to 6 weeks for that money to show up into your new account. So the problem is, particularly like what you're talking about, right? Note investing, most notes that I fund, it's like, hey, we've got a closing date set. It's 2 weeks out. It's 14 days out. It's whatever many days, but there's a specific deadline. If you don't have an account open with cash available in it, there's no guarantee you're going to be able to make that investment in time. In fact, chances are you probably won't, right? Because it takes time to do that. And we can influence the contra custodian, we can call them and we do that, but it's up to them how long it takes them to move that money. So what I say is when you have an account open and you have money in that account, you have all the opportunity in the world. No account, no money, no opportunity. So just best practice is if you know this is the path you want to go down, that's the time to set up the account and start that process, because by the time you find your first deal, you'll be set to go. You don't have to worry about missing it, right?
How long does it take to actually make the loan? Like, let's say I have the money, I'm ready to go. How long would it take from the time I find the investor I want to make the loan to? How long would that process take?
Great question. And so that takes us to our third and final D in my 3D process. So Jose, thanks for teeing me up for that. The first was decide, right? So we decided to open an account. Second one was deposit. We now have cash in the account. So now the third step in the process is to direct. And that it's this third step that makes this a truly self-directed account, because it's in this step that you tell the custodian what you want to invest your money in, and then they execute your direction, right? They just follow your directions. So I will say that the way you would do a note investment is that you would And by the way, for any specialized client or anyone who becomes a specialized client, what I always say, do this. When you're making the very first investment, call client service. By the way, our client, I never thought that this would be a huge advantage that you could tout, but we actually have real people who answer the phones, and they sit in the United States, right? I can't tell you how many people, like, I don't know about you, but a lot of businesses I call, you can't even call them anymore. You can't, there's nobody even to talk to. My suggestion is you call the office when you are making your very first investment. You say, hey, this is my first note investment. I want to make sure I submit everything and go through this correctly, and it's a smooth process. Can you walk me through it? And the staff will say, love to, right? And so then what happens is there's basically a couple things you're going to do. The first thing you're going to do is fill out what's called a direction to invest form. It's 2 pages. It's very straightforward. It's basically your name and account number at the top. It's the type of investment you're going to make. You're going to check the box that says note, right? How much are you funding this note for? You put down the amount and you say, here's where I want the money sent to, and here's how I want it sent. So in terms of the timeline, our standard processing time is 3 days, but we can process same day. So it's really driven by the client. We can do it as fast as same day. If you don't need it rushed, everything gets done and processed within 3 days. So that's a typical time frame. That's, like I said, that's assuming the account is set up and there's available cash in the account. That's the biggest thing that will make everything go smoothly. You take care of those 2 things first, then it's really quick and smooth from that point forward.
I love it. That's wonderful. Okay, so let's say now I've gone through you guys, and you guys have followed my instructions as to who I want to make the loan. How do people underwrite whether that's a good loan to make or not a good loan to make? Because I imagine, and I know this for a fact, that there's certain loans that are going to be higher risk than other loans. So the way to think about this is really think about it like almost like if you were a bank. If you were a bank, do you want to lend to every borrower? No. If you're a bank, do you want to lend on every property? No. There's certain criteria that you have that you're like, okay, I look for people that match this box. If they match this box, then I'm okay with lending the money. What are some of the best practices that you see clients do whenever they do make real estate loans? And what are some of the different considerations that people take into account when making these loans?
Yeah, so it's a great question, and there's all kind of nuances depending upon who the client is and what they're looking to accomplish, right? What I'll say from my perspective, and this is just my opinion, looking at a lot of these transactions and doing some myself, is I categorize when I'm evaluating a note, I'm evaluating that in 3 different categories: character, competence, and collateral. My whole framework falls into that. So the first thing I'm trying to assess is, who are they? What kind of person are they? And I'll give you an example of why that's important in note investing. I had a deal where I made a loan. This is going back, gosh, to the last real estate crash. When was that? That was what, 08, I think, 2008. So I had a loan out with a gentleman, and he had north of, like, it was between 20 and 30 deals going at the same time, right? And I had one note out at the time with him, and that's when everything started to implode. And all of a sudden, the bank, the prices started to come down, things started to work against him. And what happened was, he says, "Look, I am not going to be able to make good on this note. The rehab is pretty much done; it's pretty much rent ready. I will give you deed in lieu of foreclosure." That's a character issue, right? He didn't make me go through the foreclosure lawsuit. He didn't make me incur a legal expense. He says, we made a deal. I'm not able to honor it, so I'm going to honor what I can honor. I'm going to give you the property, make this super simple, right? I had no fees. That's a stand-up guy, right? That's the importance of character. Because not every, like you said, there's risk in every transaction. Not everything's going to work, but character matters. Now, I have friends and people that I know who made investments, and when they couldn't make good on the notes, they had to go through the foreclosure lawsuit, right? And that's a headache, and there's an expense to that, and so on and so forth. So character is important to me, so that's why I try to assess that as best as I can, right? That's number one. Number 2 is competence. So this goes to somebody's track record, right? How many transactions have they done? More specifically, and this kind of starts to go over into the collateral category, how many transactions have they done and what do those numbers look like that reflect the type of transaction you're now entering into, right? So if, in other words, if I'm investing with somebody who does 20 deals a month in Las Vegas, and they say, hey, we want to do a deal in Kansas City, and they've never done a deal in Kansas City before, that's new for them. They don't have any track record with that. They have great track record in Las Vegas. They don't have a track record in Kansas City. I'm not interested in being the guinea pig. So my response would be, go do a few deals in Kansas City. Let me know how those work out and give me a call back when you do. Right? I mean, that's how I would deal with it. Right? You do whatever you want, but that's what I mean by competence. And then, right, assuming they have a great track record, they have a history, they seem like an upstanding person or organization, then truthfully, right, the only deal I care about is the one that my money's on. And that's where the collateral piece comes in. And by the way, this is just something that I have learned along the way, looking at a lot of these types of transactions. The mistake that a lot of investors make when they're doing investments, and specifically with notes, is that they'll get the investor packet from the investor, and it shows all the numbers. The numbers always look good because, in fact, the only time I've ever gotten an investor packet that looked horrible was a guy who absolutely didn't have any clue what he was doing. And needless to say,
and
that
he
was
thought it
right?
looked good, but it didn't.
And he thought it looked good. He had his assistant put it together. I don't even think he understood it. But you know what I mean? Which is part of the problem for him. But anyway, the point is this: the investor packet always looks good. If it doesn't look good, for sure, run, right? But the investor packet always looks good. But here's the reality of it: that investor packet is only as good as the person who put it together. That's why the competency matters, right? So when you underwrite their track record, their competency, and you're determining that, that is what creates the value for the investor packet. But most people, let me rephrase that. I won't say most people. I'll say a lot of people that make mistakes note investing, they're only looking at the investor packet. They're not looking at the first two C's, right? They're only looking at the collateral. They are not looking at the competency or the character of the individual that they're working with. And when people do that, that's oftentimes where I see mistakes occur. In fact, every once in a while, I'll get a call from a client saying, hey, can I talk to you about something? I've got an issue. I'm trying to figure out how to resolve it. Inevitably, all I have to do is ask one or two questions. I already know what mistake they made. And the mistake they made is they ignored usually that second C, the competency. All they did was look at the investor packet. They saw dollar signs and they said, I'm good to go. They had no idea how valid or invalid that investor packet was.
Yeah, they didn't verify that. Now, let me ask you this. What is the difference between being in first position and being in second position, and maybe even being in third position? A lot of and sometimes clients think that it's bad to be in a second position loan. I personally think that loan to value or cumulative loan to value is more important than first or second position. What are your thoughts on that?
Yeah, I'll say this. It always comes back to what you know how to do, right? So I have clients who have no problem doing second position notes, right? They don't need to be in first position, but they are usually very, very skilled at what they're doing. They have expertise in that area and they know how to really underwrite those deals. Second and third positions are going to be riskier than first, right? And I've seen people get kind of stuck in a situation where, hey, the first is still getting performed on, but you're in second and you're not. So now what do? Right? You're kind of between a rock and a hard place because you can't force the hand because you're in second position. First position is satisfied. Or when if something goes south, right? Again, who gets taken care of first? First position. So there's no question that second or third position is riskier. Now, where I would say there, and I'll say this is an exception to the rule. I've seen people where I have clients where they control the first and then they'll take the second. Different scenario if you're doing that, right? I'm talking about truly second or third position where you have nothing to do with the first. So just know it's a riskier situation to be in. It really comes back to understand what you're doing, what the trade-offs are, what the rewards are before making those types of choices.
So here's what I would say to that. First position means that if something goes wrong, you get paid first. Then if there's money left over, second position gets paid, and then third position get paid. But like let's say that let's say that you have a first position loan, but you're lending 100% of the appraised value, then there's no money on the line for the investor. They have like very little money into it. I would say that the amount of equity that they have is, I would say that that's obviously risky. Now, let's say somebody has a first loan at $100,000 and you lend $100,000 in second position, but the property is worth $1 million. Like that is 80% of the equity in there. So I would say that that's less risky than the one where you have 100% and you're basically at 100. You're lending on 100% of the value because there's no equity left, meaning that investor can walk away and basically they have nothing to lose because you lent 100. They got no skin in the game versus the person that's got 80% equity in there. So in the book, The Banker's Code, they talked about somewhere around 65% loan to value ratio, like max LTV, regardless if you're in first or second position, meaning that that person has about 35% equity, which basically factors in like if there's any market fluctuations, basically. Like if there's a 20% correction, there's still equity. There's a 30% correction, there's still equity in the deal. Now, obviously, we're not telling you what to do, but these are different things that you're going to have to understand. You're going to have to understand, okay, is this a first position? Whenever you got your investors package, you got to ask yourself, is this a first position loan or is this a second position loan? How much equity is in the deal, or how much down payment is the buyer coming in with? Are they coming in with 5% down? Are they coming in with 10% down, 20% down, 30% down? The more equity that they have, a lot of times the less risk, as long as there's character, competence, and that's the collateral part. So obviously you got to look at the other two. Now, is there a limit as to how much you can charge? Like, could I charge 20% on a loan? Could I charge 3% on a loan? Who determines how much I can charge on a real estate loan?
Yeah, so I'll tell you, I'll answer that. I'll give you a couple different perspectives on that. So from an IRA perspective, there's no limit on what rate of return your IRA is allowed to make, right? Um, I have seen some pretty phenomenal rates of return on self-directed retirement accounts. In fact, I'll tell you the largest retirement account, self-directed retirement account I ever personally touched and saw was valued at $180 million. $180 million. That's a large one. The largest one that I know of, don't have him as a client, would love to, but he's not a client, has a Roth self-directed Roth IRA valued at over $5 billion. He seeded that with very little money, right? Because the IRA contributions back when he opened it were like $2,000 to $4,000 a year, $4,000 a year, I think, when he started it. Invested in startup companies, and obviously made some very wise investments because today those small dollars have turned into 5 billion. So from an IRA standpoint, to answer your question, there's no limit on how much money we're allowed to make inside of a retirement account. Okay, which goes to a different aspect now on your question, which is what are you allowed to charge? Well, there's variables there, and this is why you'll hear me say, right, it depends on what you know how to do and to make sure that you're operating in compliance with all state rules and regs. So there is something called usury laws, right, on the books. Those apply in certain circumstances, don't apply in other circumstances. So you just want to be aware of those types of things. What I can tell you is that on real estate notes, there is a variance in terms of what types of returns investors are making. I will tell you that as Specialized, we see on average people lending between 8 and 12% secured by an asset. Sometimes they're getting anywhere from 1 point up to 5 points on the front end, right? Sometimes those points are paid out on the back end, but there's usually points and an interest rate charge. And I can tell you that's the average that we see clients typically entering into note transactions. Now, obviously, there's transactions that are higher, right? I have clients who are getting significantly higher rates of return. And one of the ways that they've done that is through transactional funding, right? So they're doing short term loans at 1% a day with the idea that the loan will be out for 5 days or 3 days. But when you think about how many times, if you're able to turn that money in a tax protected environment, right, you're talking 50 to 100% ROI a year, right? Cash on cash return when you're able to do those types of transactions. So that's why I say there's a variance. It depends what you're doing and how you can go about it. But all those things are permissible within a self-directed retirement account.
Yeah, I would also say that I think that the state laws are a little bit different if you're lending on an owner occupied property versus an investment occupied property. If you're doing a real estate loan on an owner occupied property, there's a lot more protection as to what you can charge, what you can't charge. And then also, if something were to go south, there's a lot more protection than if it's an investment property, because typically investors are considered more sophisticated by nature, basically. You talked about points, and I don't think a lot of people realize this, but whenever you go to the bank, a lot of times they charge points to do the loan. And sometimes it's funny because I have clients doing annuities and investing in annuities, and the annuities charge you money a lot of times to do the annuity. Sometimes they charge you 1 to 7% to do the annuity. On a real estate loan, you can actually charge the borrower to do the loan. So, like, let's say $1 million loan at 5%, that's what, like $50,000 in additional fees that you're charging. If it's 1%, it's $10,000 on that. If it's $100,000 loan, it's $1,000 and $500,000. So just so you know, it's basically 1 percentage point of the loan amount basically that you're getting paid, or it can be 5, or it could be whatever you guys agree on. So you can actually make money on by doing the loan, not even taking into account the interest rate, which if you're charging 10% and you're charging a point or two, for the first year, it actually brings a percentage up to 12, 13, 14%, whatever, however many points you're charging. So you're actually earning a much better return on your money.
Yeah, and that's where you look at what the note states, right, and your stated rate, and then you look at points, and then you look at the number of times that you can turn your money during the course of a year, and that's where again, no earnings claims here, but just saying, right, that there's a big range in terms of what people can make note investing, because if you get anywhere from 1 to 3 points, and if you've got an established relationship with an investor who can turn money every quarter or so. Well, so if you get 4 turns a year and your stated interest rate is 12%, plus you add in those points, 2 to 4 times a year, right? Now all of a sudden you're pressing 20% or higher, right? In terms of an annual ROI. By the way, this is all 100% tax protected in your retirement account. So one of the things that I'll have clients say to me a year, 2 years down the road, once they start self-directing, is they're like, dude, I had no idea I could make this amount of money. And the reason why they say that is because we're also used to, I mean, if you've never done this before and you've never actually done transactions and built wealth yourself inside of a retirement account, then the only thing that we're doing is doing this in a very taxable world, right? And so people have no idea how punitive taxes are until you erase them from your equation and you see it on your own statement. And it grows it like crazy. Yeah.
Well, it's funny. I read a book, and it talked about the rule of 72. And the rule of 72 basically means whatever interest rate you're charging divided by 72, and that'll tell you how long it takes for your money to double. So
Yeah.
let's say that you divide 72 by 10. Let's say you're charging 10% interest. That means every 7.2 years, your money will double. That means if you lent out $100,000, in 7.2 years, you'll have 200,000. If you lend out 200,000, every 7.2 years you'll have 400,000. So, and it's you're not relying on the market fluctuations. You're not relying on what is the stock market doing, what's happening in the economy. It's basically just a different way of thinking about it. So, why do people do interest only or a principal and interest? And what's the difference between doing an interest only and a principal and interest as well too?
Yeah. So I would say, that's one of the things that, depending upon how you're approaching your investments, The great thing about self-directing is that unlike traditional investments where it's dictated to you, this is how it works, you take it or leave it. In many cases, right, you can work with the investors, right, on both sides, whether you're the one putting up the cash and being the bank or you're the one putting together the transaction. And you can work those transactions out to where you both win. This is one of the beauties of and I'll bring this back to specifically how retirement accounts can be advantageous. So we work with, I'll say, self-directed IRAs are a double-sided coin. So on one side of the coin, you can have your own retirement account to build tax-protected wealth for yourself and your family, right? With your own retirement account. The other side of that coin has nothing to do with your own retirement account. We have a lot of investors that we work with who are out raising private money, and they're targeting specifically people with IRAs, and right, because that's where the money is. To give you a perspective, the end of 2023, there was over $38 trillion in retirement accounts. In 2023, IRAs surpassed 401ks for the largest part of the overall retirement plan market. So 401ks used to have most of the money, now IRAs do. If you're looking to raise private capital, you got to go where the capital is. The capital is in people's retirement accounts. So we see it from both sides, right? And I work with clients on both sides, right? People who are fundraising as well as people who are looking to put money out and earn a return on their cash. The great thing about it is that what I will see is that in an interest-only scenario where that is beneficial, and what I say is you want to line it up with your goals. Best way I can illustrate this is to use the client, by the way, example, right, 67 years old, has money in their self-directed retirement account. They're getting Social Security, and now they want to create an income stream because they're not working anymore. So what they don't want is their principal back, right? They want their principal working and generating an income for them. So what you brought up, interest-only payments, works ideally for somebody like that because they can spend the interest. So it's the interest income plus the Social Security, which is how they're able to step out of their job, right? They got a consistent, predictable monthly income now that they've created through their self-directed account by structuring a note with interest payments. So that's one example of where somebody doesn't want all their money back. Whereas with principal and interest, obviously you're getting your principal over time. And what I always say is, if depending upon how those deals are structured, you don't ever want to spend your principal, right? You don't want to spend down on your nest egg. You can spend what you're earning and generating on your nest egg. So principal always goes back to be reinvested. That's the way I look at it. That's what I suggest for people. The return or the interest you're getting and receiving, if that's paid out monthly or however that's paid out, that's what then you can go and spend. So it really depends on what. It depends on the structure. What do you as a banker, right? If you're looking at yourself as your own private bank, I'll use your terminology. If you're turning your retirement account into your own private bank, what do you want, right? And what I can tell you we all want is a consistent, predictable income. I mean, at the end of the day, that's really what makes us, right? Because we pay our bills every month, right? We do stuff every month. So building wealth is pretty simple in the sense that you want to have assets that generate an income. It's the income that enables you to keep going, right? And so you can structure your note deals in accordance with what's important to you, right? Right now, I don't need an income. So when I do notes, I want shorter term. I want my money back quicker. There will come a time where I will convert that into an income stream, right? Where I don't want, in fact, I will tell you, the way I approach it is that I group money into short-term investments and long-term investments. And the way I define that is long-term investments. If somebody says, well, when do you want the money back? My answer is, if it's from my short-term bucket, I want it back in 12 months or less. If it's in my long-term bucket, my answer is, I don't ever want the money back. I'm making this investment to generate an income. And I don't need that income today. So, I select projects and investments that would generate an income at some point in the future. And that's how I look at it. So again, you've got to line it up with what is your overall objective? What are you trying to accomplish through the investment? But again, to go back to, I don't want to belabor the point, but it's such a great thing that you're bringing up because it's so powerful for people, because too many times they're in these traditional investments that don't spin off an income. They start drawing down on their assets. And that's why you see a lot of people working longer, right? It's not that they necessarily want to, it's that they have to.
Yeah. And that's what I love about this, because now, like, if I'm investing, if I'm lending my money out at 10%, I'm basically earning a 10% return on my money as long as I have the three C's that you talked about: competence, character, and collateralization. I would say that the risk is lower than a different type of investment. Now, what is the term personal guarantee in a note? And is that ever used by any of your clients?
If you're lending from your IRA to someone, can you have them personally guarantee it? 100%. There's no problem there. What we're not allowed to encumber the IRA or the retirement account. So in other words, we're allowed to borrow in the retirement account. We just aren't allowed to personally guarantee the money for our retirement account. Neither is our retirement account allowed to guarantee it. So yeah, if you're lending money to someone else, 100% you can get a personal guarantee. No problem there.
So basically, what that means, at least my understanding, let's say I'm lending out on your property on 123 Banana Street, and I'm asking for a personal guarantee. That means if something were to go wrong on your property on 123 Banana Street, I can go against other assets that you may have, basically,
Personally,
with the
correct.
personal guarantee. And the reason I'm asking this is because if you're the bank, I'm trying to give a little bit of guidance as to different things that you can ask for to help you feel more comfortable and reduce the amount of risk that you have on the table. Should people run credit scores? If I'm lending you money, should I ask for a copy of your credit report to see if you've got a high FICO, a low FICO? Is that something that you look at, or any of your clients typically look at?
I'd say that varies, right? I have clients who will run full background checks. I'd say it really comes back to your personal experience and comfort level. If you kind of go with what the bank does, right? Banks run credit checks, and they absolutely look at credit. And so that can be an important thing. Like I don't use a lot of credit personally. I'm at a point where I'm on a cash basis for most things anymore. But that doesn't mean I don't manage my credit score. I know exactly where it stands from month to month. And I know how to impact it, right? Because if I want the ability to borrow, I want to be able to demonstrate that I'm a worthy credit risk, right? So 100%, I think that whatever somebody does, like you definitely want to have your underwriting criteria for sure, right? And you want to have that dialed in so that you can make those types of decisions.
100%. So, like, if you notice somebody just had a bankruptcy 6 months ago, red flag. You notice somebody just had a short sale very recently, short flag. You want to think like a bank, because that's essentially what you're doing. You're basically being the bank for other people. There's so many different ways to structure these real estate loan deals. I think that it opens up a world for people. I want to do a future video with you on investing in businesses, and I want to do one on transactional funding as well too, if you're ever open to it. But I
Sure.
do want to say thank you, Edwin, from the bottom of our heart. If somebody wants to go self-directed and hire your company as a custodian, where could they find you guys?
Yeah. So a best place to go is specializedtrustcompany.com, specializedtrustcompany.com.
I love it. I want to say thank you, Edwin Kelly, Specialized Trust Company. I appreciate your time. And to our viewers, if you've enjoyed this episode, hit the subscribe button, hit the share button if you feel that this would be helpful to somebody else. And thank you again. And we'll be doing more episodes on this topic.